Welcome back, everybody, to the second lecture video for Chapter 7. So remember, in Part 1 of this chapter, we talked about the definition for GDP and the different kinds of transactions that are included in the GDP. And we left off that video talking about there being two ways to measure GDP. The expenditure approach, which I want you to know really well, because that's going to be coming back for the rest of the class and all the chapters from here on out. So again, make sure you understand how to use this expenditure approach for the rest of the course. And then the resource cost income approach is something that you're not going to see as often, so I'm just going to ask that you're able to recognize that one without going into as much detail about it. But whether you use the expenditure approach or the resource cost income approach, again, either way that you calculate it, you should come out to the same number. They should equal each other. They're just two different sides of the same coin. So with that in mind, let's talk a little bit about how to calculate this expenditure approach, or again, how we actually calculate GDP using this expenditure approach. So the expenditure approach is given to us by this formula here, and on your own and while you're taking notes, it might be recommended that you make a list of what I call symbols and equations, because they're going to start to add up from this chapter onward. And the first equation in that list should be this expenditure approach for calculating GDP, and that is y equals c plus I plus g plus nx. Y is our abbreviation for GDP. Looking at 2019 GDP with the numbers in billions from the Bureau of Economic Analysis, our 2019 GDP was $21,427,700,000,000, roughly. So again, when we look at these numbers are in billions. So that's $21,427,700,000,000. And so again, Y is our abbreviation for GDP, and that is a combination of these next four things. Next thing on that list is consumption, and that is about $14,562,700,000,000 worth of that GDP, or close to 68%. Every year, consumption is by far the largest component of GDP, which is something I want you to remember. Private investment is the next component there. That's our I, and that's $3,743,900,000,000, or about 17.5% of GDP. Government consumption and gross investment are basically what the government's spending money on, or the goods or services that the government is providing. That comes out to $3,753,000,000,000, or again, right around 17.5%. And then net exports, which are exports minus our imports, is actually negative because we import more than we export here in the United States, and that's That's a negative $631,900,000,000, right? So about negative 3%. And so on average, that net exports is usually fairly small and negative, right? So again, you combine consumption, investment, government expenditures, and those net exports together, and you get the total GDP. Right, so with that in mind, these numbers are again from the Bureau of Economic Analysis for the year 2019. And I don't really care that you know these percentages as much, or that you know these dollar amounts at all, right? I just care that you know that consumption is the largest component here of GDP, because again, that's something that's going to come back around here in the future. But let's again go through and talk about how each one of these is calculated one by one. So consumption is household spending on goods and services, again, during the current period, and that consists of durable goods. And durable goods are goods that you tend to kind of reuse a lot throughout your lifetime. So example of a durable good would be a house. It's not something you just use once and throw away. It's something that you continue to stay on or stay in as you continue to live your life. Another example of a durable good might be an automobile that you drive, again, continuously for a long period of time. It could be things like a washer or a dryer or a dishwasher, right? So a lot of appliances are considered durable goods. Again, you use them multiple times throughout that product's life history. And so durable goods are about $1,526,800,000,000 worth of that consumption measure. Again, I don't care if you know these numbers as much, but just to give you an idea of kind of how these things are adding up. Non-durable goods are goods that you tend to consume in a short period of time. So food would be an example of a non-durable good, right? You consume it once and it's gone. It's not something that you continue to consume for years at a time, right? Another example of some non-durable goods might be things like trash bags or toothpaste or toothbrush or things like that, right? Things that, again, you consume for a short period of time, right? And then they're gone. They're not something that lasts for years and years and years. Another example of a non-durable good might be condoms. If you're using a condom as a durable good, then you're probably using it wrong, right? Something that should be used once and then thrown away. And then finally, services, which makes up the largest component of our consumption measure here, as we are very much largely in a service industry or service economy. And so services could be things like if you hire a real estate agent to help you sell your house, that's a service that agent is providing. Any legal services, so if you get arrested and you have to hire a lawyer to help you face those charges, that's an example of a service. When a doctor treats you for any kind of illness, that's an example of a service. It could be, again, somebody coming over to clean your house, or somebody putting helping you build a new addition onto your house, somebody providing you with an oil change. These are all examples of services that are being provided. Right. So again, consumption is the largest component of GDP, and if you add those three things together, you should get that number there and the consumption component. Right, so with that in mind, if we're calculating out GDP using this expenditure approach, and I tell you that $100 is what's being spent on durable goods, $200 is what's being spent on the non-durable goods, and services, so a total of $700 being spent on it, then you should be able to calculate out that there's being a total of $1,000 for the consumption component of GDP, and so the $1,000 is what would go up here, and then we have to add together all these other components as well. So let's talk about how to do that. So the next component that we talk about is the I, or investment, and sometimes referred to as gross investment. That is production or construction of capital goods that provide a future service, right? So basically these are goods that are being produced but might not necessarily have been sold yet, or goods that are used to help provide or produce other future goods. And again, there's two parts to this. There's what we call fixed investment, which is the investment that companies make in providing or acquiring goods that are going to be used to produce other goods. So it might be like a conveyor belt that a factory puts in. It might be a forklift that a factory uses to move goods around, right? It might be the trucks that the company purchases to transport goods from one state to another, right? Anything that you produce to help you produce more goods, this might be known as fixed investment. And then the other type of investment that gets added into this equation is what we call inventory investment. And that is what you've added to your inventories throughout the year. So again, if you produce something in 2019, that gets added to 2019's GDP, even if it doesn't get sold until 2020. And so how does that get added? Well, it gets added through this inventory investment, which is how much you have in your inventory at, say, the end of the year in 2019, minus how much you had in your inventory at the beginning of the year of 2019. That's how much gets added to your inventory throughout the year that you haven't been able to sell. Right? Again, it's production that's happening that year, so you have to include it somewhere. It would be included here under inventory investment. So with that in mind, let's go through an example of how to calculate that. Right, so again, let's say that this is a company that has a fixed investment of $400. That's how much they've invested in, say, new machines that they're going to use to produce future goods and services. Right, let's say they had $200 in their inventory at the beginning of the year, and then they had $300 in their inventory at the end of the year. Let's go through real quickly how to calculate this. I'm going to exit the full screen mode so we can use a different color here. All right, so again, when we're calculating our inventory investment, or this I component of GDP, I is equal to our what's called business fixed, or just fixed investment, F there, plus what is known as our inventory investment. It's inventory investment. And that inventory investment has again got its own equation. That is your ending inventory, or what you have in the inventory at the end of the year, minus your beginning inventory, or what you had in your inventory at the beginning of the year. Because again, that's how much you've added to your inventories throughout the year that you just haven't sold yet, right? So again, if you're calculating that I component, you're going to have $400 in fixed investment plus, it looks like we had $300 at the end of the year, but we had $200 at the beginning of the year. So we had $100 worth of stuff that was produced throughout the year that just hasn't been sold yet. So that's been added to our inventories. So we add that to the $400 of machines that we have bought to produce future goods. And again, that's going to give us a total of $500 that gets added through that investment component to GDP. Right. So again, be very careful in terms of when you see these numbers, how to calculate out these different components. Right. So again, our investment equation is fixed investment plus inventory investment, and that inventory investment is ending inventory minus beginning inventory. So again, make sure you know how to calculate that component of GDP as well. All right, continuing on, let's go ahead and talk a little bit about government expenditures. So government expenditures includes any spending by the government on goods and services. So this could include the money it pays police officers to perform their police duties, money you pay soldiers in order to protect the country through our national defense system, or it could be money you spend on, say, papers and staplers when you're typing up bills and stapling them together and presenting them to Congress, right? It's any kind of those administrative expenses as well. And then it also includes spending on what we call capital goods. And you think of capital goods as like the major expenditures of the federal government, or kind of like the durable goods of the government. Those capital goods could include things like producing missiles or creating or repairing highways, right? These are all capital good expenditures. Again, think of it as kind of an investment that the government is making in these kind of big time expenditures. So you add those together and that will give you your G component of GDP. Now I want you to be very careful with this one. This is where a lot of students make mistakes. Remember that we talked about in part 1 of chapter 7, in that lecture video, we said that transfer payments are not included into this calculation for GDP, right? So just because the government's spending money doesn't mean it gets added to GDP. If it's spending money on a good that's being produced or a service that's being performed, that will be added to GDP. But if they're, again, taking money from one group of people and giving it to another group of people, that won't be included in GDP. So any Social Security expenditures, again, isn't included in GDP because, again, you're just taking money from people who are below a certain age and giving it to people who are above a certain age, right? Again, any spending on things like welfare, where you take money from people who are above a certain income and give it to people who are below a certain income, right? Those expenditures won't be included in GDP. Or things like unemployment benefits, where, again, you're taking money from people who are working and you're giving it to people who are not working right now. Again, that won't be included into GDP either. Right, so I'm not saying that these transfer payments aren't valuable. I'm just saying that they won't be included in GDP because they are not measuring anything that's being produced. They're not measuring production. Now, another thing to kind of keep in mind when you're talking about government expenditures is that they're included at cost rather than necessarily value added to the taxpayer. And what I mean by that is if the government is paying a police officer $50,000 as their yearly salary to perform their police duties, then that $50,000 is what gets added to those government expenditure portion of GDP, regardless of what that police officer does. So if they prevent $1 million worth of crime, then again, they're still counted at the $50,000 that they are getting paid. If they're just sitting around eating donuts all day and not really doing anything useful, then they're still getting counted at the $50,000 at which they are being paid. So again, government expenditures are counted at the cost of the taxpayer, not necessarily the value added, which could be higher or lower depending on what that good or service is doing. So kind of keep that in mind as you're thinking about how government expenditures are influencing GDP. So let's go through and calculate the government expenditure approach here, or the government expenditure component of GDP in this expenditure approach. So again, I'm going to exit this full screen mode so we can use the purple color that our G is representing here. All right. So again, this is a government that has paid soldiers and police $300 to perform their duties. They spent $200 on creating missiles and repairing highways. They've transferred $100 between groups in terms of welfare payments. They've also transferred $150 in unemployment benefits and then $250 in Social Security benefits. So the thing to keep in mind here is that the welfare, unemployment, and Social Security, remember that those are not being included because nothing is being produced there. So the only numbers that you'd add together, regardless of all these numbers that you might see in the question, are again the goods that are being produced and the services that are being performed. So in this case, just those top two. So $500 would be the total that the government is providing or contributing to GDP, which is again the measure of production for our economy through that G component. Right. So kind of keep that in mind as you are answering these kinds of questions on the exam, is that those transfer payments, remember, are just not included. Only the goods that are being produced or the services that are being performed are being included. All right, so let's move on to the last component, and that is net exports. Again, net exports are just exports minus imports. And again, in the United States, that number is usually negative, indicating that we import more than we export, or we have what's called a trade deficit. That isn't necessarily a bad thing, and we're going to talk about why when we get into Chapter 9, right? But just for now, know that for the United States, net exports is a number that's usually small and negative, right? So exports are domestically produced goods and services that are sold abroad. So things that would, in the United States' case, would be produced in the United States and then sold to other countries. So things that the United States tends to produce and sell abroad are things like pharmaceuticals, technology, including microchips, and then things like airplanes. These are all things that the United States are kind of notorious for producing within this country and then selling to other countries. And then imports are foreign produced goods and services that are purchased domestically. So it's things that the United States would buy from other countries. And so things that the United States tends to buy from other countries are traditionally things like sporting goods, so like soccer balls or footballs or things like that. And then textiles or clothing, right? Those are things that the United States would again purchase from other countries. So they're produced abroad and then bought by people here in the United States. So again, if exports were greater than imports, then this is something that would add to GDP, which remember just counts the things that are produced within the borders of a country, right? But if our imports are greater than our exports, like is the case with the United States, this number would be negative, right? Again, indicating that more things are being produced abroad and being bought by Americans than are being produced by, say, Americans and then sold abroad. So again, GDP only includes those things that are being produced within the geographic borders of a country. So therefore, exports will add to GDP, but imports will subtract from them. Okay. Let's go through that calculation of that net export component, again, within this expenditure approach. In order to do that, right, we got to take a look at these exports and imports. So this country, in this example here, is exporting $200 worth of stuff, yet they're importing $300 worth of stuff. So again, remember that our net exports is calculated as our exports first minus those imports, which if you use these numbers and you do that calculation, that is 200 minus 300. That's going to give you a negative 100. So that negative 100 is what is calculated or included into that expenditure approach for GDP. Right, so again, that negative 100 is what gets added here. And now that we have all four components calculated, we can add them all together in order to calculate our total GDP. Again, abbreviated as Y. So C, remember we have $1,000 from consumption. Remember that's usually the biggest component of GDP. We got 500 from investment. We got 500 from the government expenditures that measure production. And then we have a negative 100 in net exports. So if you add all that together, that is 2,000 minus 100, or a total of 1,900. That is the calculation for this country's GDP using that expenditure approach. Some people ask me, why is it that Y is the abbreviation for GDP, even though Y doesn't really appear anywhere in the words gross domestic product? It's just something that economists have decided a long time ago. Our best guess is that GDP is often measured on the vertical axis of a lot of graphs, in which case that's the Y-axis, and Y usually refers to our output or our outcome. And so that's why we usually abbreviate that as Y. Right. With that in mind, though, again, I would keep a list of abbreviations and equations, starting with this equation, Y equals C plus I plus G plus NX, and then all these abbreviations, Y, C, I, G, and NX. Know what they mean, because as we use them later, it's just going to be easier to look them up if you have them all together on one list. All right, so let's try an equation, an example here using this equation and see if we understand how to do it. All right, so Grills Inc. is a company that makes custom-made mouth jewelry. They had $500 worth of inventory in their warehouse at the beginning of 2019 and $800 worth of inventory in their warehouse at the end of 2019. They also bought a $600 new jewelry polishing machine in 2019. How much did the actions of Grills Inc. add to 2019's GDP? Right, so again, remember the formula when it comes down to this I component, that's equal to fixed investment plus our inventory investment. And remember, our inventory investment is the amount of inventory we have at the end of the year, so our ending inventory, minus how much we had at the beginning of the year, or our beginning inventory. So you just plug in those numbers and you should be able to calculate that out. Make sure that you don't mix up that inventory investment equation. Remember, it's ending minus beginning because it's measuring how much we've added to our inventories throughout the year. Right, so if this company bought a $600 new jewelry polishing machine, we're going to add that to our fixed investment. That's going to be our fixed investment. And then we said that they had $800 worth at the end of 2019. And they had $600 worth at the, $500 worth at the beginning of 2019. Then we can see that they've added $300 to their inventories throughout 2019. So 600 plus 300 is equal to 900. So if you chose C here, then you would get this question correct. So to be able to do these kinds of calculations, a question like this on the quiz or exam, it might be by itself or it might be part of a bigger question where I ask you to calculate all four components and then add them together to calculate that GDP. Right. Now, it is the case that if our beginning inventory was higher than our ending inventory, then that inventory investment would be negative, and that would subtract from our total investment or I component to GDP. So again, if you have our ending inventory is less than your beginning inventory, that means that your inventory has been subtracted throughout the year. Again, that would subtract from our GDP. But it's usually the case that ending inventory is higher than beginning inventory, meaning that this inventory investment component will be positive and will be added to fixed investment so that you can get that I component. But again, it could go either way, so make sure you know both ways on how to do it. All right, so that is the expenditure approach. Again, make sure you know that like the back of your hand. That's why we went through that one very carefully. The next thing we're going to go over is the resource cost income approach. And again, I don't care that you be able to calculate all these out or that you know any of these percentages or anything. For this one, just be able to recognize it. So if I throw this equation on the exam, know that this is the resource cost income approach. Again, in case you see it in future economic classes, but you probably won't see it again in this particular economic class outside of maybe, again, a question on the test. Right? So this one is calculated by adding together all employee compensation. So rather than focusing on expenditures, we're going to focus on money coming in. Right, and that includes anything that employees earn in wages or salaries, right? And that's about 54.6% of GDP through this particular method of calculation. Again, I don't really care that you know that particular percentage. Add to that proprietor's income, that's at 7.7%, and this is the income of those people who are self-employed or independent contractors, people who are providing their own labor. If you add together employee compensation, which is the compensation of people who work for other people, versus proprietor's income, which is income that people earn working for themselves, if you add those two together, it's usually somewhere just below about 2/3 of GDP using this particular approach to calculating it. We also add to that rents, which comes in about 3% of GDP. So if you're somebody who's renting a building out to somebody else or a room out to somebody else, the income you earn through that counts as rent, and that would be added through this particular part of this approach. It could also be if you're renting out a machine to somebody else, right, then that would be added to this particular part as well. Corporate profits is at 12.4%. So this is the money that is that serves as returns to stockholders, or money that is earned by those shareholders who own those financial assets. Basically, when you own stock, you are a part owner of a company, and you let that company use your money in exchange for ownership of stock in that company. When that stock increases in value and you sell it and make money from that transaction, right, that's included there in these corporate profits. Interest income is included at 3.2%. Basically, if you are providing a loan to somebody, that's a service that you are providing, and providing that service, the interest that you earn in return for allowing somebody to use your money now, right, that counts as interest income and is included in this part of this GDP calculation. So if you have money in a bank account and that bank account pays you some interest, you earn that money, you declare it on your tax returns, right, that gets included there. If you are a bank that is providing a loan to somebody else, maybe you also have a loan from that same bank, and maybe it's a student loan or a housing loan or a loan for your car, and you have to pay the interest on that loan, right? Well, again, that is money that the bank is earning and would be including on their tax returns or on their income statements, and that would be included there under this interest income component. Indirect business taxes refers to any taxes that increase a firm's cost of production. Could include something like sales tax. So like if you pay $1 for something, it might actually cost you like $1.08, depending on what state you're buying it in, because you have to pay that 8 cents tax. So that gets included under this component. And then we have depreciation, and depreciation is basically your assets wearing out. So if you've ever bought a new car, you know that if you try to sell that new car, once it's no longer new, it loses a lot of value. It depreciates considerably when you drive it off the lot. So the fact that that car loses its value, right, that is included there under this depreciation component of GDP. Same thing about any machines that a business owns. So if a business buys like a forklift for $100,000, when it has to declare what it has in its assets the next year, it might declare that same machine at $80,000 because it is worth $20,000 less, given that it's got some miles on it and has depreciated over time. And the final one is net income of foreigners, which is the income that foreigners or people who are not U.S. citizens earn within the United States, minus the income that U.S. citizens earn abroad. Right, so you take all the income of people who are not citizens of this country, but again, they're producing stuff within the borders of the United States, so they're earning income here in America. You take all that income and you subtract from that the income that U.S. citizens are earning abroad, and that's what gives you the net income of foreigners part of this resource cost income approach. And that number is usually small and negative. The reason why is that there's a lot more people from other countries earning money in the United States than there are U.S. citizens earning money abroad. But it's often the case that the money that U.S. citizens earn abroad is more per person than the money that foreigners are earning within the United States. So it kind of balances out a little bit to the point where this number is usually incredibly small, or a small part of the resource cost income approach. So you add all that together and you get this calculation for GDP. So that's a lot of stuff, and again, that can be kind of a confusing calculation. I'm never going to ask you what any of these percentages are. I'm never going to ask you to add all these up individually, but if I throw this particular equation on the exam and ask you what is it called, you'll be able to tell me that it is called the resource cost income approach. Right, so that's kind of all I want you to know from that one, but again, know the expenditure approach that we just went through item by item, know that by like the back of your hand. Know that very well moving forward. All right, so the last thing that we're going to talk about here in this particular part of this Chapter 7 lecture video is gross national product, or GNP. And again, the number I'm going to give you here is in billions. So this number here is $21,427,100,000,000, right? And GNP is the total market value of all final goods and services produced by the citizens of a country during, again, a specific period here, right? So again, it's very similar to our GDP calculation. It's still the market value of all final goods and services produced, right? But it's by the citizens of a country, no matter where they are, rather than the production that's happening within the geographic borders of a country, no matter the citizenship of the person who's doing it. And so that's how GNP and GDP are different. right, is that GNP counts the income that Americans earn abroad. So as long as you are a U.S. citizen, any money that you earn will be added to U.S. GNP. However, if you earn that money in a different country, it will not be added to U.S. GDP, right? It does ignore the income that foreigners earn in the United States. So if you are, say, a Chinese citizen that is working and producing things within the United States, again, that will be added to U.S. GDP, right? But it will not be added to U.S. GNP because you are a Chinese citizen and not a U.S. citizen, right? So again, it counts the income that Americans earn abroad. It ignores the income that foreigners earn in the United States. So if you are a U.S. citizen that is working within the borders of the United States, then your production is going to add to both U.S. GDP and U.S. GNP. If you are an American citizen that is working outside of the geographic borders of the United States, then your production will count towards U.S. GNP, but it will not count towards U.S. GDP. If you are a foreign citizen that is working and producing within the geographic borders of the United States, then again, your income will add to U.S. GDP, but it will not add to U.S. GNP, right? With that in mind, the biggest question I get here is, what about somebody who has dual citizenship? How will their production count? And again, these measures are not perfect. So if somebody is, say, both a Canadian citizen and a U.S. citizen, right, then their production will add to both Canada's and U.S.'s GNP. So both countries can claim that citizen's production towards their GNP, meaning that it is double counted, right? So again, this is not a perfect measure. There are some problems with it, that being one of them. Right. So let's go through this question and see if we can figure out what's happening here, or this is similar to a kind of question that may appear on a quiz or exam. So this question is from one of my favorite movies, Rocky IV. Ivan Drago is a Russian citizen. He travels to Las Vegas, Nevada, which is located within the United States, where he defeats Apollo Creed in a boxing match. His earnings from this fight, is it A, would count as part of US GDP and Russian GNP? Is it B, count as part of US GNP and Russian GDP? Is it C, would count as part of US GDP but would have no effect on Russia, either their GNP or their GDP? Or is it D, would be double counted, raising both US GDP and Russian GDP? And the answer here is that because Ivan Drago is a Russian citizen, but because the production he is doing, or the service he is providing, is happening within the borders of the United States, his earnings from this boxing match would count towards Russian GNP, which again is the citizenship of the country. But because it's happening within the borders of the United States, it would add to US GDP. Again, that is the production of what's happening within the geographic borders of a country. So this would add to Russia's GNP and the United States' GDP, right? So again, these are the kinds of questions that you'll have to answer on the test. So make sure you know how to answer these particular questions, all right? Moving forward, right, that is going to be it for part 2 of chapter 7. When we come back next time, we're going to talk about how to adjust for price changes, or what's the difference between nominal values and real values. We're going to do things like calculate a price index, and then learn how to calculate a real value using those price indexes, right? So that's what we're going to be talking about in our third and final lecture video for chapter 7. But that's it for now. If you have any questions about anything that we went over in this lecture video, please, again, shoot me an email or come see me in the Zoom office hours, and I'll be happy to answer those questions for you. Until next time, though, that's it. So just let me know if you need anything, and take care.